The agenda for this call. So this call is to provide some information about myself, my approach, what happened in Q4 with my portfolio, also the macro situation, asset prices, and a bit of an outlook looking forwards through, in this case, the rest of this year. So this will examine data in the last calendar quarter of last year, so up until the end of December or the beginning of January. In terms of my background, so I'm an immigrant from South Africa. I moved to the UK in 2008 during the financial crisis, right at the end of 2008. It was very difficult to get a job, and my wife and I, well, my girlfriend at the time, we burned through all of our savings very quickly. We had to rely on the generosity of our friends. I have spent the past 20 years, sometimes as a consultant, and sometimes as a business owner, and sometimes as a consultant in those businesses that I've owned. I am a published author, so I've written a book on technology, and I have spoken at many events, some very large tech events around the world, Europe, South Africa, and also the US. I'm mostly a full-time Etoro popular investor, although where I spend my time depends. So I do have another company that I've been kicking off, a technology company in parallel, but investing is by far where I spend most of my time. I've traveled to a lot of countries, so I grew up quite poor, and the first time I ever traveled to another country was, I think, when I was 18 or so. But since then, I've managed to travel quite a lot. I've started 4 companies. One of them was very small, so it didn't really make a huge difference to my life, except whilst I owned it, it was quite nice. I was quite young. And the most recent of the companies failed. It was a business travel startup that I started in 2021, just before coronavirus, before the pandemics hit, and the pandemics crushed that company completely. But my 2 other companies have been quite successful, one of them in particular. And my favorite movie from the past year has to be Triangle of Sadness. Highly recommend that movie. In terms of my investment journey, so I was born in 1980, by the way. So I started investing in 1999. This is kind of not true because my parents gifted me some stocks when I was 16, but I didn't really do anything with them. They were given to me and didn't do much. So I started investing in 1999. After I left high school, I had a managing director, and he really made me very curious about this investing thing. He was a fabulously wealthy man. And so I invested in one company, and that company had done very well. It was South Africa's biggest technology company at the time. And then the dot-com bubble burst shortly afterwards, and the price came all the way back down to earth. So that was the first time I burnt my fingers investing, but it's triggered some curiosity. And I spent a lot of time studying, teaching myself, meeting with people that had been investing through their careers, either as their career or on the side of their career. And then I have been formalizing my knowledge through the 2010s or so. I joined Etoro in 2015 through a friend of mine, and I became a popular investor in 2016. I've done that initially on the side whilst I was running my other company, a company that grew quite large, actually. It was the largest of its kind in Europe at the time. As well as doing a number of other things. I do enjoy being quite busy. So I'm a property investor, started building a property portfolio in London about 4 years after I arrived. Property was still quite cheap after the market got crushed because of the financial crisis. So I got quite lucky there, but then became quite interested in that kind of assets. And my wife and I worked our asses off and saved like there's no tomorrow in order to start building a portfolio. Since I've had some success in businesses, this has allowed me to advise and also invest in other small companies. Some of them are successful, some of them aren't. But as much as I teach them, I also learn from them. I've been a crypto investor. I don't talk about this quite a lot in eToro, and I don't invest heavily in cryptos on eToro, but I've been involved in cryptos for at least a decade, to the degree that I mined cryptos in my lounge. I built my own mining rig, and with GPUs when that was still feasible, and mined all kinds of cryptos. And I also, sometimes I don't invest in companies, but I join companies as a business advisor from time to time. In terms of my expectations, so I bang on about this quite a lot, and it's something that I've learned along my journey as an investor. So when you are deciding whether or not to get involved with a particular investment, it's good to understand what that investment is about and what your expectations are, and whether they align with your not necessarily capabilities, but what you're able to take on. So some people are very, very low risk, as an example, and so they might want to just invest in bonds, although there's been quite of a wacky ride recently, or maybe utilities, for example, so high dividend yielding utilities, whereas other people are okay with higher amounts of risk, and you find that there is some correlation with age, by the way, if you read the studies. And so I would say that cryptos, for example, are one of the highest volatility, highest risk areas within the market. So you need to know yourself, but also what you might get out of a particular investment. And so my approach is that my portfolio tends to be quite concentrated, and not necessarily in a very few companies, but certainly within industries and sectors. And so my personal expectation is that there will be a chunky amount of volatility within my portfolio, and that means on the way up as well as on the way down. But overall, I expect this to lead to a higher return than the market, and the market here in this case being measured by popular US indices such as the S&P 500 and the NASDAQ Composite or NASDAQ 100. So this is just a bit of a history of, ignore the yellow line for now, but if you look at the blue line and the red line, going back to 1986, this is the NASDAQ. If you'd invested, I think, $10,000 in the NASDAQ and S&P 500, the NASDAQ would have been a much bumpier ride, far more difficult ride, but you still would have achieved a higher return. And this is using real figures in the NASDAQ and S&P 500, by the way. So then I haven't been investing in my portfolio since 1986. So I've had to model part of this curve, but my expectation is that the NASDAQ 100 is to the S&P 500 as my portfolio is to the NASDAQ 100 in terms of volatility and return. I also wanted to pull up a case study. So, and this doesn't just apply to me or copy me. It happens to investors everywhere, to people that copy others on eToro. So just as this case study, so some of you will know Peter Lynch. I like Peter Lynch, his investing philosophy, his personality, and also he was very, very successful. So over a 20-year period, his fund, the Magellan fund, had a very great return with an average annual return of 29.2%. So it might be a little bit small for you, so apologies, but the pink line is the return of his fund, and the green line is the SPX. And so you can see he outpaced significantly the S&P 500, as I've already just said, but the ride was volatile to get there. And so on the right, you may have read it already, but this is an extract from someone that analyzed Peter Lynch's performance. And so even though he had a return of 29% annualized return over that period, he calculated that investors in the fund, on average, only made 7% during that same period. And the reason for this is that when the fund wasn't doing very well, when there were rocky times, people would exit, and then when he got back on track, the money would flow back in, and so people would miss the recovery. And I think this is a very common story. I mean, I did this in the early days of investment too. It's a very common mistake to make. All right, so in terms of my investment strategy, so I have 4 pillars that I consider my strategy. So there's my style of investment, my style of analysis, how I implement my strategy, the portfolio construction, if you will, and the expectation, which I've already spoken about. So in terms of my investment style, my investments are almost always long-term, so months or years, although sometimes there are momentum trades in there, but they're a very small percentage of the things that I invest in, or in this case, trade in. Having started businesses and worked with companies, when I invest in a company, I imagine that I am acquiring that entire business, because that's what you do. When you buy a stock, you're buying a piece of ownership of a company. It's not just speculation on whether the price is going to go up in the long term. So it becomes a slightly different beast when you're in that mindset and looking at the fundamentals and understanding a particular company. At times when the markets have rallied for a while, I'm happy to pivot to a growth at a reasonable price approach when required. So for example, halfway through a bull market, or maybe late bull market, things will be expensive in that market. So you're not going to find anything dirt cheap like you can at the moment. There are lots of things out there that are dirt cheap. So you need to look for those things that are reasonable given their capability to continue to grow. I almost always prefer profitable growth. And in my portfolio, there are very few companies that aren't turning a profit. There are a few, but those are companies that I think are on the cusp of getting there. So it's all good and well to have fantastic revenue growth, but you need profit to feed into the company to make it sustainable. You can't rely on external investors the whole time for your company. I do tend to be USA focused. I'm not sure of the exact balance at the moment, but this tends to hover around the 60 to 70% mark in terms of the portfolio allocation. And I do expect some volatility because of the concentration of my portfolio. I'm going to go a little faster, otherwise I'm not going to have time for Q&A. So in terms of analysis style, for me, the most important things are the fundamentals of the business. So I think that I am fairly good at understanding the accounting of businesses in certain sectors, at least. But on top of that, I also need to understand the business model, the competitors, the leadership team. You can imagine that by trying to understand a company just from its books, from its balance sheet, from its cash flow statement, you're going to miss a lot of very important pieces of information. So does the company rely on a single product, in which case it's not very diversified? How many competitors does it have? How good are those competitors? Should we be investing in those competitors instead? For example, I also try to make sure that I am investing in businesses that are in growing industries. So the investing game is to some degree a game of numbers. You cannot guarantee that every investment that you make is going to be successful, and you don't need them to be, but you need to be right more than you are wrong. And so you're trying to make sure that you have as much on your side as you possibly can. So a growing industry means that there's already a tailwind for the companies involved in those industries. And then the bottom three, I talk about macroeconomics quite a lot because that picture changes quite frequently, and it's good to understand what's going on in the world and driving price action, but it's not something I rely on heavily when it comes to investment. And then politics can be interesting, but again, I don't rely on it heavily. So if there are bills being pushed through that favor certain industries or types of companies, then that's good to know. For example, in the US, the investment that they're making in semiconductors is very good for that particular industry, obviously. So that type of information can be quite important, but there's actually very little when it comes to politics that is good in terms of the long term, the 10, 20 years tenure of a business. And then lastly, I do look at technical analysis. but it weighs very little in my investment decision. So I think that everyone that comes to investment, not everyone, but lots of people, they start out trying to find the little secrets hidden in technical analysis that will allow them to make lots and lots of money. But like anything in this world, it's not that black and white. Technical analysis is very good because it tells you about the psychology of the market. So things like resistance points and support points, they work quite well. They don't always work, but they work quite well and they work quite frequently. And that's in part because they have worked historically, that people use them that way. But also because, for example, humans like round numbers. So you'll find a lot of support and resistance numbers around round numbers. And then, so strategy implementation, I've spoken about this a little bit already. So the vast bulk of my portfolio is there for months and years. There are some momentum trades that I might make, and there I will rely sometimes on technical analysis, but also usually earnings. So there needs to be a trigger, a setup for the technical analysis to work. I tend to build positions over time because you never know if the market is going to collapse tomorrow or go crazy tomorrow. So for example, Taiwan Semiconductor is a company that I'm very interested to build a position in, but I'll spend some time doing that. I don't use leverage because just would increase a portfolio that's already quite volatile, and it adds fees. And I don't hedge often, but if I did, it would be using indices. And hedges always have a cost. So I read a lot of research papers. And so when people hedge, the hedge only works out, it only goes in their favor 2/3 of the time. So it's really there as an insurance policy. Insurance costs you money. And then I've spoken about expectations. All right, portfolio construction. So just a last quick little bit about portfolio construction. So my portfolio, I consider it to be a core and satellite kind of approach, although that definition usually means something different, by the way. So here at the core, I tend to hold bigger companies, and bigger companies are usually lower risk because of their size, which means they have more money, they have access to more money, debt if they need it. So they can, and they usually have, they're more diversified in terms of their products and services that they sell. So if there's weakness in one particular area, there's another area that can hold them up. And around those, the satellites tend to be the smaller companies. And they're usually not very small companies either. I don't think there's any company in my portfolio that has a market cap of under $500 million. But you can't squeeze as much growth out of a large company as you can with smaller companies. And so this combination allows my portfolio to, my risk of losing capital is lower because very few of these companies are going to go under. In terms of the portfolio themes, so these don't change very much from quarter to quarter. So online commerce is still a big growth area, particularly in developing nations. So I think South America e-commerce is growing faster there than anywhere else. And it's also starting to grow quite fast in Asia, particularly Southeast Asia. Fintech is also another growth area. So developed nations are fairly cashless, maybe not the US, but Europe. We deal less and less with cash, but there's a whole world out there that is still very cash oriented, and that's changing quite fast. The death of cable. So this is referring to the fact that there are lots of streaming services, and there are some companies that I think have still got quite a lot of growth left in them. I think Netflix has done well, but they're approaching a saturation point. However, companies like Warner Brothers Discovery, they've been absolutely battered through the past year or so following the merger, and they're carrying quite a lot of debt. And now the market is waiting to see if the leaders can deal with that debt effectively. They've laid out their plan, and actually they've executed part of their plan quite well. So there are a few companies that I think could do quite well. So lockdown recovery, there are still companies that are in recovery mode. So I don't know if you've been following, but through the past week or so, there've been a few airlines that have been reporting their earnings results. And I think I saw the first bad one today. I haven't followed all airlines, but I do follow quite a few of them. And many of them have said that they are returning to profitability through this year. And a lot of them have a lot of debt, but many of them, their share prices have been incredibly subdued. But it looks as though they are bottoming out now, and that this year is going to be good for them. They still will have to pay off the debt, so we'll see how good it will be in the end. Business automation. So this is an area that I think will do very well through the next decade or two. So Salesforce is an example of this. Salesforce is in a political battle at the moment, so it might not be the best example, and it keeps on acquiring too many other companies. But there are other companies out there that also handle business automation that I think will do very well through the next decade. Now, I think in the short term, the very short term, so let's say through the next 6 months, we could have a rough patch for this type of business. Tech companies are laying off people, huge numbers of people, and a lot of the investment projects that big companies undertake in order to improve themselves have been put on pause, whilst everyone's seeing what the economy is going to be like. But I think 6 months, fine, maybe not so great, maybe flat, but beyond that, they will continue to grow. Next gen ad tech. So ad tech is a huge part of the global economy, and I think there are some companies there that are going to they'll become leaders and probably be acquired by the big dogs through the next 5 to 10 years. Semiconductors. So just about everything contains microchips, and more stuff is containing microchips, and things are containing more microchips, and the sophistication of those microchips are changing. So this, I believe, will be a strong industry depending on where you invest for the next decade or two. So AI, for example, needs a hell of a lot of data, and it needs to process that data, and so it requires very specialized microchips in order to facilitate those capabilities. So that's one area that will continue to feed into the semiconductor businesses, but there are others too. And China reopening. So I didn't update the description there, apologies, but China abruptly, as we all know, ended its zero COVID policy late last year, and there are already signs that the economy is starting to recover. I think that it'll be held back a little bit by other countries as there's a big slowdown in many developing nations. But I think that unless the government does something completely unexpected, and they have done that before, I think that there's a strong recovery to come in Chinese equities. I'm not going to go through this because I am low on time. And for those of you that copy me, you might be familiar with what some of my biggest holdings are. I'll leave it up there for a second for you to read through. All right, so my lifetime goal is 20 years with a compound annual growth rate of 25%. And I know given last year and 2021, this will be met with some skepticism. My current Etoro lifetime CAGR, I think, is about 19%. So I do need to make up a little bit to get it back up to that 25%, but this is my goal. I do believe that it is something that is achievable over a multi-decade investing career. In terms of the Q4 headline topics, so these are the big things that happened through the last quarter. It does seem as though we've seen peak inflation, at least in some of the leading economies, and it's not just a single data point now, it's a trend that we've seen. I'm sure that everyone has been following that quite closely, since that is a key data point that's been driving the Fed and other central banks' decision to raise interest rates. There was another bear market rally, so I think it was I don't know if it was the third or fourth bear market rally, and it collapsed through December. So I think through November, part of November, the market rallied quite hard. And there was a lot of tax loss harvesting towards the end of the year. So this came up quite frequently, and I don't think I found a solid measure of how much this happened. But US investors, they tend to sell investments that have done poorly towards the end of the year. So for example, let's say you had invested in Apple and it had fallen 30% by the end of the year. If you sold that position, you could carry that loss over to the next year, and you can offset that against gain. So let's say you make an investment somewhere else and it has a huge gain, then you can take that loss and you can subtract it from the gain, and you only pay tax on the difference between the two, which is something you can do in the UK too. So US investors tend to do this towards the end of the year, and that seemed to hit parts of the market quite hard. Other headline topics. So the warm autumn and then into winter really changed the picture quite a lot. The world got very, very lucky. So gas prices have collapsed. They're much lower than they were at their peak, and even since I think November last year. And the inflation in Europe has largely been driven by energy prices. And so the expectation of lower prices has affected sentiment and some prices, although the lower prices are the bulk prices and they will only flow through to the end consumer later in the year. The end of coronavirus, zero COVID, was very abrupt and slightly unexpected. China tried to deny it when the message did leak initially, and it created all kinds of havoc within the country, but it does seem as though the worst of that is behind us, although for the Chinese New Year, there's a lot of traveling within China. So let's see what effect that has on the coronavirus numbers through the next month or two. The Ukraine war continues, which means that supply chains have had to be rebuilt in slightly different ways, and some of them will take years to be rebuilt, which affects prices. And so I think this could be a challenge for energy prices in next winter, which I'll talk about in a moment. The dollar has dropped, I think, nearly 10% in 3 months. And this was putting a lot of pressure on many parts of the global economy, as well as the markets. So lots of the things that investors buy are priced in dollars: oil, gold, US stocks, US indices as examples. So you were paying more if your currency had weakened against the dollar, but also many countries have debt that's priced in dollars. And so when they pay, let's say they've got a monthly servicing cost, they need to pay a portion of the interest on that debt. If their currency had weakened, then these huge amounts that they need to repay, and those countries are becoming poorer because of that. Also, things that they import from the US would have been more expensive, which drives inflation in those economies. So this drop is a welcome drop. It's still, the dollar's still very, very strong, but its drop has helped out quite a lot. Tech layoffs. We've heard a lot about tech layoffs. So maybe this is my bubble because I've worked in technology a long time. So there are layoffs in the thousands or tens of thousands happening, not just in the US, but I think those are the ones that we hear about the most. And the strange thing is, and I was reading a bit about this morning, is that employment in the US still is quite resilient. So employment numbers are still quite strong. And this is something that the US Fed is watching in order, it's a data point that they're using, the key data point that they're using to determine what they do with interest rates. But if you look at the trend, the employment rate in the US is down, just not as fast as analysts have been expecting. In the last quarter of last year, so we got a lot of good macro news. So that, the turning of inflation, for example, GDP in some countries being unusually strong, PMI has been unexpectedly strong, but the Fed wanted to make sure that people didn't go crazy in the markets effectively, and wanted everyone to know that they still mean business. And so that led to the messages, I think in early December, of rates are going to go high, maybe slightly higher than you expect, and they're going to stay there for longer than you expect. And this seemed to be part of the trigger for the December sell-off that we saw in many equities. And economies have softened, but it's been patchy, right? So there's been resilience in economic numbers, but it's been offset by various industries being a little weak. So housing, for example, has dropped the price of houses or the number of houses sold in countries such as the US, UK, Australia has dropped significantly. In terms of performance stats, so the S&P did quite well, and I'll talk about what parts of the S&P did quite well in a moment. The NASDAQ was about flat, and my portfolio was down by about 1%. The Russell 2000, which are smaller companies, also rallied quite nicely. Again, it was because of the certain industries, similar to the S&P 500, just smaller companies within those industries. In terms of my lifetime performance, what that means for running up to the end of December 2022, it means that my portfolio has returned 289%, NASDAQ 148%, which is pretty fantastic, 82% for the S&P 500, and the Russell 2000 hasn't done very well over the past 7 years or so, at 47%. In terms of the areas that did quite well, didn't change very much or did badly. So in the US, finance, healthcare, and utilities, so lots of defensive sectors did very well through Q4. UK big cap companies also did quite well. And this is because those businesses tend to be very large international companies, but also are finance companies or insurance companies, which I guess are finance companies, or energy companies, which had done quite well. European indices did quite well through Q4. They didn't do fantastically, but they did okay. And through this month, which isn't included in Q4, obviously, they've done very well. China kicked off the beginnings of their recovery, and Australia did quite well. These lists aren't exhaustive, by the way. So there was little change in the price of oil and non-precious metals. A little bit of change, but not a huge amount to speak about. So non-precious metals being the likes of copper. Bond yields in the US didn't move around as much as they had, particularly when you look back through the rest of the year. So those rates, expectations about interest rates remained more or less as they were. And US big tech didn't really move much either. In terms of the losers, I spoke about the US dollar already. Smaller technology companies in the US didn't do very well. The price of natural gas completely collapsed. And semiconductors did awfully, although they've had a very strong recovery through January. Now, the reason I suspect that semiconductors did quite poorly is because they're seen as a bellwether of the near-term point in the economic cycle. So the semiconductors are seen as being very highly cyclical, very closely tied to the economic cycle. And so if there is weakness expected in the economy in the near term, they get a little bit punished. Although I don't know how many of you have been following semiconductor earnings. Some companies have done very, very well through the past quarter, and their forecasts for the coming year are still very strong. In terms of portfolio changes, so there wasn't much that changed through the last quarter. I sold up my Booking.com holdings at a loss. I can't remember the size of the loss there. But the reason was my thesis for Booking.com, Booking Holdings, was for a much stronger recovery in travel and travel bookings through 2022. And that did happen. And Booking Holdings did very well in terms of their revenue, but for all other types of reasons, that didn't translate into a huge amount of profit. And the share price didn't move nearly as much on the growth of revenue as I anticipated. So my thesis there had become invalidated. There was a timeline on that investment, and I had a momentum trade on Rio that I sold out of. In terms of looking forward, and so if I was going to say a timeline on this is for at some point in this year. Next year is a different thing altogether. So inflation, I think, will continue to decline, but I think that this might pause slightly higher than people expect, especially into year end. I'll come back to why in a moment, and to some degree that's geographic. earnings are very important. So earnings are coming in mixed at the moment, which is surprising quite a lot of people. So some of them are coming in okay, and okay is good news when sentiment has been sour for so long. But forecasts are just as important as the numbers that have been reported. There's been lots of talk about a soft landing, and apologies if you don't know the terminology. So this is spoken about quite a lot when people talk about the Federal Reserve and the US economy. So the idea is that the Federal Reserve's actions allow the company to bring inflation down and avoid a recession, or maybe only go into a very small recession. So will a soft landing happen? No one knows this, but it doesn't. It looks as though we're not going to get the super deep recession, the worst case scenario that had been expected. I mean, it's still on the cards, but it's seemingly less likely given that inflation is coming down, employment numbers are still high, GDP numbers out of the US are still decent, sentiment is turning. In terms of rate hikes, so again, no certainty in this, but it seems as though we will likely see the peak in rate hikes, at least for countries such as the US, UK, and some countries within the EU. No countries want to crush their economy, so they'll do everything that they can to bring down inflation, and they will take a slight beating on economic growth, but they don't want to create an all-out depression. So it looks like inflation is doing what they wanted to do, in which case rate hikes are likely to peak. But I think that they might stay at those levels for longer than people are expecting, potentially through to early next year. In terms of the energy crisis 2.0, so this is something that's really worrying me, and it's not specific to Europe, but it's probably more pronounced in Europe. So if the Ukraine war continues, we are still in the process of building the supply chains to get energy into Europe, and that won't complete for years. You know, there are some low-hanging fruit, there's some quick wins, but it's not all going to be like that. You can't build gas pipelines or build new gas-carrying ships to fully get enough energy to Europe by next winter. So there's a chance that, and I don't think it's unlikely that we're going to have many winters that are going to be as warm as the last winter, or the winter that we're in. So if that doesn't happen, that could mean that energy prices stay where they are, potentially go a bit higher, maybe they're slightly lower, but they're not going back to where they were a few years ago, excuse me. And since European inflation has been driven quite largely by energy, what does this mean for inflation? Do we get a second bump in inflation when this happens? So China, I think, will continue to grow. There's the messaging that they're putting out at the moment is all about growth. They seem to have contained their financial crisis, and it's kind of bottomed out in their markets. They've been putting the pedal to the metal in terms of different ways to not only support the economy but to drive growth. So I think that China will grow through the next year. The question is, with so many of its major trading partners experiencing challenging economic growth, how much will that hold China back? I also expect lower correlation in asset prices. So when you have the very tail end of a bull market, or the bulk of a bear market, a lot of asset prices tend to become highly correlated in the direction that they're moving, at least. So on the way down in big scary crashes like the one that we've experienced through last year, many asset prices they ignore fundamentals. Fundamentals of a company matter very little when fear is high, and so that everything just about everything becomes correlated, as we saw last year. What we're starting to see is a breakdown in that correlation. So now we're starting to see some assets that are traveling in different directions from the general market. And And I think that that's a trend that we will continue to see through this year. So fundamentals may continue, but may start to matter more through the coming year. And the dollar, I'm not sure if the dollar weakened significantly. I actually meant to update this block, and sorry, I missed it. So I don't know if the dollar continues to weaken. The weakness in the dollar was a combination of high interest rates in the US plus fear, which drives people to the safety of the dollar. And now that interest rates around the world have started to catch up and fear is starting to dial down a little bit, we could see further weakness in the dollar, but I don't know if I'd make a call for the rest of the year, the direction that the dollar travels in. It could just go sideways. So I talk about this quite a lot. So I think when people watch those inspiring videos on YouTube, you know, with Warren Buffett or Charlie Munger talking about being patient and doing the boring thing and being invested for the long term, it's inspirational, and the knowledge, you know, you're getting these insights into how these great investors achieve their returns and become very wealthy over the long term. But then when you experience that journey, it's a very different thing. So having the knowledge and experiencing the thing are quite different things. And it's not just about being patient, but I think impatience is a very big risk. It's very boring sometimes to be invested in the stock market and be successful. So I think a lot of people can be impatient, but also your emotions can get the best of you. It's very easy for your emotions to get the best of you and drive you to do things that you shouldn't do. So I think having a plan, having the right expectation, as I keep on banging on about, having an investment plan that you can refer back to, you know, see your thoughts at a point in time, are important to being successful in the long term. So in terms of closing remarks, so my portfolio got absolutely blasted through December. The NASDAQ 100 did too. And the market became very oversold. So we're seeing quite a strong rebound this month, particularly in those weakest areas. I suspect that part of the selling, the areas of selling that we saw in the last month of last year were driven by tax loss harvesting. So people that had big drawdowns on particular investments sold those investments that had big drawdowns and forced those assets to fall even further. But it looks as though sentiment has shifted a little bit. There's a bit more optimism, but also that those areas that had been enormously oversold, investors are coming back to them. I don't think that as investors, we're out of the woods just yet. January has been good, and quite often January does set the tone for the year, but there are a lot of negative influences, potential impacts that we could see through the coming year. Part of it is winter and energy prices in Europe. I'm not sure how those are going to impact things. The other is how weak our economy is going to get. No one knows the answer to that. And so if unemployment rapidly rises throughout the world, and it's very difficult to undo what the Fed and other central banks have tried to do in driving inflation higher, I think that could present a challenging environment for the market. That being said, there are lots of companies that, even those that have rallied, 20, 30% through the past month or two, they're still cheap. There's still companies that will do very well through the coming decade or two. An example there, which is quite hilarious, is Shopify. People overbought that like crazy and then dumped it like crazy. And I suspect a lot of the trend in the price action for that particular company was because of the price action. So because something's going up, people buy it, which makes it goes up, which makes people buy it, and the same on the way down. But if you look at the fundamentals of that company, I think that they're sorted for years to come, probably the next decade. All right, and then on the right is just some information, some stats about bull markets and bear markets. So 3/4 of years are bull markets, 1/4 are bear markets, and the gain in bull years tends to be much higher than bear markets. So even if you lose to the market, it depends on the degree to which you lose to the market in a bear year. If you are able to beat the bull market for those other 3 years, 3 out of 4 years, then you can make a really strong return. All right, so that's it. And we do have some time. I saw some questions come through. So Peter has asked, I'm surprised you haven't added to your Mercado Libre position since Jan 2022, despite the 20% drop since you bought. You see more of a hold than a buy. No, I see it as a buy. So I need to, some degree, I need to manage my my risk score, and Mercado Libre has been one of the positions that's contributed most to my risk score. However, it is a company that I would like to own more of. It's building out this fintech capability. It's kind of like Alibaba building the Ant Group, but at the very beginning of when they started building the Ant Group. So no, I still think it's a very good company. There are a few reasons though. I also wanted to keep some cash on hand, so I've maintained about 10% of the portfolio as cash, probably for 2 months, maybe 3 months. And the reason for that was just to kind of hedge the price action on the rest of the portfolio, but also because I wasn't sure that the worst was behind us. I am a bit more optimistic this year, but I do want to keep some cash in reserve. I think that the performance through January has been very strong, and that alone, I think, could cause a bit of a pullback as people take profits. I think people are going to be very nervous about the market becoming truly bullish for a while. So I think there'll be a few false starts and it'll pull back a bit. So I think that there'll still be opportunities. And no, I think it's a good company. How do you know this was the peak of inflation, not just peak of the cycle, and we're not due for another wave of inflation? We don't. And I don't tend to invest based on predictions of inflation, although it's good to know because it helps me understand why the market's doing what it's doing at any point in time. I think your question came in before I spoke about Europe and the energy prices. So I don't think anyone knows the answer to that question. I think that we need to be careful about Europe because the ingredients for EU inflation to bottom out and maybe pick up again, I don't know to what degree, are there. But we won't know until later in the year. Thoughts on Digital Turbine Q3 ER? I was impressed by Q2, and I'd imagine Q3 will similarly showcase some positivity. I think Digital Turbine is going to be a fantastic company. It's one of my favorite businesses. So outside of Etoro, in my tax wrapper account, I invest quite heavily in Digital Turbine. It's very, very volatile. So it has a very strong effect on my risk score. But as soon as the market has settled a little bit more, it's another company that I would like to add a bit more to my portfolio. They have such an enormous moat. They are the only company that provides the end-to-end capabilities that they do. They also have partnerships with the biggest mobile providers, or some of them in Europe and the US. Their acquisitions have been spot on. They've got a lot of flack for their acquisitions, like they pay too much. And I think that there might be one dud in their acquisitions, but the others have borne so much fruit already, and I think will continue to do so. I suspect Google will buy them, but that's not the reason that I own the stock. I think that they're a cash printing machine. I think that as the economy turns down and businesses spend slightly less on advertising, their revenue and their profitability will be hit. Although you bring up the ER and actually look very, very good. Their CEO was slightly cocky about how well they'd done. sorry, Q2. So it's a very well-run company, good acquisitions, enormous moats, ad tech, and it has a capability that I'm sure Google is, very hungry to own. But even if Google doesn't buy them, I think that once the economy turns, margins will go back to the fantastic levels that they were at before. Those are all the questions I have. Are there any other questions? Let's stop that. All right. If that's it, then I will end the session. Thank you very much for attending. I will share a recording of this if for some reason you want to watch it again. All right. Thank you very much. Bye.